Hey everyone, want to wish you a very happy New Year 2020. Hope for you and yours is going to be an amazing year, an amazing decade. And we are going to have a look at Apple here today. I have been talking about Apple quite a bit. I do think it is probably one of the most important, if not the most important story stock out there right now. Not just because it's Apple, but let me just quickly say something before we talk about Apple. There's an event out there that happens in January of this year. It's called Wealth 365, and it's being put on by my good friend Rob Hoffman. I have a lot of respect for what they do. The event is really it's second to none in terms of the quality and of information you're going to get from all sorts of different speakers. I'm personally going to speak there as well. I would highly, and I really mean that truly, highly encourage you to sign up for that. It's a free event. You'll get a ton of information, different strategies, things you'll just simply not get anywhere else. So just wanted to say a quick word on that to get you started for 2020, which, by the way, I think will be a very different year from what we saw in 2019. I think the next decade actually is going to be very different as well. We've been preparing our clients for that, and we're going to continue to do so. And I'll put on snippets out on YouTube as well on that and Instagram. But we need to talk a little bit about Apple. Now, let me just be clear. Before we look at Apple here today, I want to make sure that you understand I'm not here to troll Apple or talk negatively about Apple. If you look closely, actually you can't see it right now, but I have an Apple Watch. This is an iPhone here. I've got Apple products everywhere. Although my PCs, the ones that the big screens work on, those are PCs because it's just for big screens. Anyway. The point is that this is not an Apple hater video. I like Apple. I like what they do. I like their products. I even like the stock long term, but I really dislike it here at current levels. Now, in full disclosure, I have been very cautious. In fact, actually bearish on Apple since about October of this past year. The stock then rallied like I think almost 30% or something into year end, which clearly was wrong, or at least early in my part. But I want to talk a little bit about what's going on in Apple, okay? So first of all, before we look at the charts, I want to quickly say this. It's important to understand that the Fed started injecting liquidity because of a repo crisis. Basically, JP Morgan withdrew billions of liquidity from the repo market that forced the Fed to add liquidity, and that led a lot of indexers, passive investors, and ultimately algorithms to basically jam the market higher into year end. Apple being a massive part of people's portfolios and just generally being a huge stock, 1.3 billion in market cap. The stock rallied, I think, 85% last year. It was basically taken along with that. And if you look at Apple, basically stock rallied, or excuse me, the S&P rallied about almost 1% for every 1% that the Fed increased its balance sheet since October. So this is a meaningful sort of correlation trade. It's a structural thing. I don't think the rally in Apple had much to do with fundamentals at all in the fourth quarter. And again, I'm not saying just to hate Apple. I love what they do. There's been a real shift in terms of what they're trying to do from moving from a more of a hardware focused company with iPhone sales to a software company. And I think ultimately they might succeed in that. But the problem is that iPhone sales have topped, or excuse me, smartphone sales globally have topped, a long time ago, so to speak, like several quarters ago. That's kind of long term for these kind of things. And if iPhone still being a major part of the company's portfolio, I just don't know how these numbers are going to add up. In order to comp the comps, I think that's basically an impossibility in my opinion. So that's the fundamentals. But aside from the fundamentals, let's have a look at the charts, and this is really where things get concerning and crazy. So I've given you a little bit of, hopefully, some structure, kind of where I'm coming from, fundamentally, but more importantly, structurally, why the stock rallied so much. It wasn't because of the fundamentals, at least I don't think. It really was more to the Fed liquidity and all that kind of stuff into year end. So let's have a look. We'll flip the cameras, and let's have a look at by the way, this is the registration page for the Wealth 365. Again, it's a free event, but please go ahead and register. I think you'll do yourself a great favor into the new year. So I've made a few charts here. So just to give you some ideas, this is the long-term chart of Apple. I'm quickly position the tripod here a bit. And I'm saying this because I think the stock actually at this point poses structural risk to the entire market, right? Now, whether you like the stock or not, and again, I like the company, you probably would argue, you could see that this is a bit silly, right? It's overshooting its long-term channel by a mile, and it's gone completely vertical. This is that structural issue that I talked about before. To give you some perspective on this, here are some statistics. Some of those I just mentioned, but I'm quickly mentioning again. The stock rallied roughly about 85% for 2019. That's not a small thing for a stock that obviously is a major company out there. 35% from October till year end. This is where I got squeezed. Obviously, that wasn't. It was wrong to be bearish, if you will, but nothing's really changed in that picture. 10% in December alone. Market cap 1.3 trillion. If you look at this, just go back to the long-term chart quickly. I know I'm jumping back and forth a little bit. From a momentum perspective, the stock has not ever been close as overbought from what's called a D Oscillator. It's a very simple oscillator. It basically measures how far removed the stock is basically from its moving averages, if you want to keep it very simple. And you can see it's completely gone vertical. On the daily chart, this is the weekly chart. This here is the daily chart. I'm going to zoom in more. So I know that you guys are probably getting dizzy from all my flicking around here. But you can draw another chart, and this one the way I've drawn it here doesn't give the rally just the vertical move we've seen. But we can draw another, and this is a more near-term channel, since you can see basically August of last year, and this is called a megaphone pattern, right? Kind of expanding, and you can see we've once again reached the very upper end of this. We're very, very removed even from the 50-day moving average, not even to mention the 100 and 200-day. Currently, the stock is trading about 10% above its 50-day moving average. That has happened before, of course, but every time that kind of happens, the stock tends to mean reverts, right? You can do that. You can look at it last time. It's even been removed more than that before, right? But we've since rallied another 10-15% since it happened last time, and the stock will always pause. So to make a long story short, I think the stock here is so overbought. And again, this is probably, you get the better picture here in the long-term weekly chart, that, just taking some profits here is the very, very least the thing to do. I don't think the stock will see much higher prices, and it probably won't revisit these prices in a long, long, long time. So taking profits is something that I would certainly consider doing. I think you could even make short bets on the stock if one is inclined to swing that way. Shorting the stock right here, anywhere between 290 and 300 or thereabouts. Buying March puts, at the money puts, maybe at 290, 270 bear put spread using March options. And again, the imagination in terms of how you express your view is endless. You can do however you want. You can do that however you want to do. But I hope I'm making the case where you can see I'm not saying this to be bearish. And people always wrote to me over the past couple of months, Serge, you don't like Apple. That has nothing to do with that at all. In fact, like I said, I like the company, but I want to be realistic, and as an investor, I have to keep the emotions out of it. So I see parabolic charts like that, particularly in a stock that's a major, I'm going to call it almost a systemic risk to the broad market. And I just feel like it's my duty as an investor and trader and I guess kind of a public person out there in this world to warn people about this, not to be bearish and nasty about it. It's just to be truly expressing my concern for the company. Again, I've been wrong on this for some time now, so that's not the issue, right? I'm not trying to cover up and double down. I just want to continue telling people that I think it's much riskier now than it even was in October, right? So again, just take that for what it's worth. Again, I would certainly encourage you to sign up for the Wealth 365 event. The link is down below or in an email if you're getting this by email. That's my pretty mug right there, but obviously there's a lot of other speakers, and I think you guys will absolutely love this. With that, again, have a very happy New Year, good start to the year, and I'll talk to you guys soon.